On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice and it doesn't take into account your situation, objectives, goals, or risk tolerance. All investments are subject to risk and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services or to view the Craig's Investment Partners Financial Advice Provider Disclosure Statement, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Please engage with us. We love to get feedback, questions, and comments on this material, and if you enjoy it, please rate it, or even better, share it with a friend or colleague. It's been a very volatile few weeks for investors, with some markets and asset classes falling heavily amidst the uncertainty. All market declines are different, and it's impossible to say when or where or how this one will end. However, here are a few suggestions from me that might help you navigate this period. Number 1, resist the urge to panic. That's a really important piece of advice. It's hard not to feel overwhelmed by all the negative news we're hearing, but we don't make our best decisions when we panic. Stay calm, take a step back, and lean on your advisor for support and guidance. This is when they earn their keep. Number 2, don't be afraid to take a little bit of risk off the table or to hold more cash than usual. There's nothing wrong with a bit of de-risking, especially if you're still sitting on decent gains, if your riskier assets have grown to represent a larger part of your portfolio than intended, or if it'll simply help you sleep at night. Holding more cash than usual can also be wise. If things remain volatile or if they get worse, having some dry powder means you can take advantage of opportunities that might arise. Number 3, consider adding to your conservative assets. With yields of more than 4% available for good quality securities, New Zealand fixed income is still offering very reasonable returns. While interest rates have come down from recent levels, if an economic slowdown or even a recession ensues, they could easily go lower. Those periods typically go hand in hand with lower rates, so a bond and fixed income portfolio might even deliver some capital gains in the period ahead. Number 4, within shares, it's not too late to de-risk your portfolio. Every sell-off comes against a slightly different backdrop, but some parts of the market have traditionally held up better than others. There have been 4 recessions in the United States since 1990, and 2 sectors have proved most resilient, outperforming the broader market on all 4 occasions: consumer staples and healthcare. At the other end of the spectrum, financials and technology have, on average at least, been the laggards during those 4 periods. Now, you've got to be careful because you don't want to sell out of one sector at the bottom and buy another near the top, but some portfolio fine-tuning might help you prepare for any further bad weather. This is something you can work with your advisor on to make sure you get those adjustments right. Number 5, and this is a really, really important one, if your investment objectives haven't changed, then neither should your strategy. Most of us are investing in the hope of meeting our long-term objectives, and these are often 10 or 20 years into the future, sometimes even longer. Now, with that in mind, it doesn't make any sense at all to react to daily, weekly, monthly, or even yearly volatility. We know that over longer timeframes, growth assets like shares, or property for that matter, will deliver strong returns with remarkable consistency. Investing is not about chasing the ups and downs of the market. It's about managing a well-constructed portfolio in line with your goals and objectives. Just remember that. Next one, stay diversified rather than being at extremes. Economies, markets, and currencies ebb and flow, so hedging your bets across different asset classes, geographies, and sectors is the most sensible approach for most of us. Yes, being fully invested in the share market will open you up to the full force of these volatile periods, but you'll do yourself just as much of a disservice by being too conservative. So again, don't be at one extreme or the other. Make sure that you have a balance and you're somewhere in the middle. Last one, I think it's tip number 7, Be willing to take opportunities amongst the carnage. Again, a really important one for long-term investors. We all want to pick our moment to snare a few bargains, but don't sit on the sidelines waiting for the stars to align perfectly. I can tell you now, they never will, and markets can rebound very strongly when you least expect it. If you're too cautious, you'll remain in portfolio limbo and miss out on the recovery. This is a really important point, especially for new investors to remember. If you're in the accumulation stage of your investment journey and you've got many, many years to retirement, volatility and weak markets, they are your friend. In fact, you could almost argue that for those people at least, the lower prices go, the better. We never know what's around the corner for financial markets, but if you're building a portfolio rather than winding one down, you've got to be willing to take advantage of the weakness, the uncertainty, and the nervousness out there. Take your time and do so in installments, but you've got to do something. That's all for today, team. Talk again soon. Thanks for listening.
For more insights, visit craigsip.com.